Welcome back. Amanda Stickle here. I'm here to help you try to make sense of IRS publications to help you through the process of filing and preparing for your taxes with your business. So we have been working on IRS publication 334, the tax guide for small business taxes, for those of you who are filing a Schedule C. So I'm going to go ahead and share my screen. And then go ahead and subscribe so you can stay up to date when I post the additional videos when we're going through this publication. And I also post other videos regarding taxes and business finances. So we are on chapter 2 today of publication 334, accounting periods and methods. Introduction. You must figure your taxable income and file an income tax return for an annual accounting period called a tax year. Also, you must consistently use an accounting method that clearly shows your income and expenses for the tax year. You may want to visit publication 538, Accounting Periods and Methods, for more information. Okay, so accounting periods. When preparing a statement of income and expenses, generally your income tax return, you must use your books and records for a specific interval of time called an accounting period. The annual accounting period for your income tax return is called a tax year. You can use one of the following tax years: a calendar tax year, which is, we'll talk about it, but January through December, or a fiscal tax year where you decide what the year looks like. Unless you have a required tax year, you adopt a tax year by filing your first income tax return using that tax year. The required tax year is a tax year required under the Internal Revenue Code or the income tax regulations. Calendar tax year. The calendar tax year is 12 consecutive months beginning January 1 and ending December 31. You must adopt the calendar year if any of the following apply. You do not keep books. You have no annual accounting period. Your present tax year does not qualify as a fiscal year. Your use of the calendar year is required under the Internal Revenue Code or the income tax regulations. If you filed your first income tax return using the calendar tax year and you later begin business as a sole proprietor, you must continue to use the calendar tax year unless you get IRS approval to change it or are otherwise allowed to change it without IRS approval. For more information, see change in tax year later. If you adopt the calendar tax year, you must maintain your books and records and report your income and expenses for the period from January 1 through December 31st of each year. Fiscal tax year. A fiscal tax year is 12 consecutive months ending on the last day of the month, except for December. A 52 to 53 week tax year is a fiscal tax year that varies from 52 to 53 weeks, but does not have to end on the last day of a month. If you adopt a fiscal tax year, you must maintain your books and records and report your income and expenses using the same tax year. For more information on a fiscal tax year, including a 52 to 53 week tax year, see publication 538. So an example of a fiscal tax year could be like your start of the year is November 1st, and then you end it October 31st. I think that I did that right. So it's just different. You're not ending it December 31st. You have different start dates, and a fiscal year could be if you have high peak seasons during a period in the year. So you want to make sure you're reporting appropriately your income and expenses for the tax period that you're looking at, so that way you can file taxes appropriately and related to your income when you receive it. It can be confusing, but as long as you set it and then you have it posted somewhere so that you can remember your due dates and all that. Usually bigger corporations do this. Most small businesses will stick with the calendar tax year, and that works well for most small businesses. Change in tax year. Generally, you must file Form 1128, application to adopt, change, or retain a tax year to request IRS approval to change your tax year. See the instructions for Form 1128 for exceptions. If you qualify for an automatic approval request, a user fee is not required. If you do not qualify for automatic approval, a ruling must be requested. See the instructions for Form 1128 for more information about user fees if you're requesting a ruling. Accounting methods. An accounting method is a set of rules used to determine when and how income and expenses are reported. Your accounting method includes not only the overall method of accounting you use, but also the accounting treatment you use for any material item. You choose an accounting method for your business when you file your first income tax return that includes a Schedule C for the business. After that, if you want to change your accounting method, you must generally get IRS approval. Kinds of methods. Generally, you can use any of the following accounting methods: cash method, an accrual method, special methods of accounting for certain items of income and expenses, combination method using elements of 2 or more of the above. You must use the same accounting method to figure your taxable income and to keep your books. Also, you must use an accounting method that clearly shows your income. And they will discuss that more. Typically, though, with small businesses, cash method is the easier, simplest, most effective way to go. Business and personal items. You can account for business and personal items under different accounting methods. For example, you can figure your business income under an accrual method, even if you use the cash method to figure personal items. 2 or more businesses. If you have 2 or more separate and distinct businesses, you can use a different accounting method for each if the method clearly reflects the income of each business. They are separate and distinct only if you maintain complete and separate books and records for each business. So the cash method. Most individuals and many sole proprietors with no inventory use the cash method because they find it easier to keep cash method records. However, if an inventory is necessary to account for your income, you must generally use an accrual method of accounting for sales and purchases unless you are a small business taxpayer, determined later in the chapter. Income. Under the cash method, include in your gross income all items of income you actually or constructively received during your tax year. If you receive property or services, you must include their fair market value and income. Example, on December 30, 2021, a client sent you a check for interior decorating services you provided to them. You received the check on January 4, 2022. You must include the amount of the check in income for 2022. So even though the client sent you, they wrote the check on December 30th, you didn't have that check in hand or available to you until January 4th because of the holidays and the mailing process. So you didn't receive that and you weren't able to actually have access to those funds until January 4th of the next year. So you would report that in the 2022 year. Constructive receipt. You have constructive receipt of income when an amount is credited to your account or made available to you without restriction. You do not need to have possession of it. If you authorize someone to be your agent and receive income for you, you are treated as having received it when your agent received it. Example, interest is credited to your bank account in December 2022. You do not withdraw it or enter it into your passbook until 2023. You must include it in your gross income for 2022. So once you receive it, so same with the check example, say you received a check on December 30th, but you didn't deposit it until January 4th. You received it December 30th, so that is when you would report it as income for your tax purposes, because you actually had it available. It was just your choice not to go to the bank or deposit it at that time. Delaying receipt of income. You cannot hold checks or postpone taking possession of similar property from one tax year to another to avoid paying tax on the income. You must report the income in the year the property is received or made available to you without restriction. Example, a service contractor was entitled to receive a $10,000 payment on a contract in December 2022. They were told in December that their payment was available. At their request, they were not paid until January 2023. They must include this payment in their 2022 income because it was constructively received in 2022. Checks. Receipt of a valid check by the end of the tax year is constructive receipt of income in that year, even if you cannot cash or deposit the check until the following year, like I was just discussing. Example, Dr. Red received a check for $500 on December 30, 2022 from a patient. Dr. Red could not deposit the check in their business account until January 3rd, 2023. Dr. Red must include this fee in income for 2022. Debts paid by another person are canceled. If your debts are paid by another person or are canceled by your creditors, you may have to report part or all of this debt relief as income. If you receive income in this way, you constructively receive the income when the debt is canceled or paid. It's considered income because somebody else is paying it for you, and they're just kind of taking out that third party of you receiving it. You're still receiving benefit of those funds by those expenses being canceled. Repayment of income. If you include an amount in income and in a later year you have to repay all or part of it, you can usually deduct the repayment in the year in which you make it. If the amount you repay is over $3,000, a special rule applies. And we can find out more about that in publication 535. Expenses. Under the cash method, you generally deduct expenses in the tax year in which you actually pay them. This includes business expenses for which you contest liability. However, you may not be able to deduct an expense paid in advance, or you may be required to capitalize certain costs. Explain later. Expenses paid in advance. You can deduct an expense you pay in advance only in the year to which it applies. Example, you are a calendar year taxpayer and you pay $1,000 in 2022 for a business insurance policy effective for year 1, beginning July 1st. You can deduct $500 in 2022 and $500 in 2023. So you just need to break it up accordingly to what's applied to each year. Accrual method. Under an accrual method of accounting, you generally report income in the year earned and deduct or capitalize expenses in the year incurred. So those are the big changed words. The purpose of an accrual method of accounting is to match income and expenses in the current year. So I'm sure that'll explain it, but when they say to match the income and expenses, if you incur expenses for a service provided and you didn't report the income, you would end up potentially having a large loss. But when you report the income when you earn it and the expenses when you incurred, they should balance out, and whatever's left would be an accurate match of your taxable income. Income, general rule. Under an accrual method, you generally include an amount in your gross income for the tax year in which all events that fix your right to receive the income have occurred, and you can determine the amount with reasonable accuracy. For a taxpayer with an applicable financial statement or other financial statement as the Secretary may specify, the all events test for an item of gross income is considered met no later than when taken into account in an applicable financial statement or other financial statement. They just like to add a bunch of words. I'll explain this if it's not clear in this example. Example, you are a calendar year accrual method taxpayer. You sold a computer on December 28, 2022. You billed the customer in the first week of January 2023, but you did not receive payment until February 2023. You must include the amount received for the computer in your 2022 income. So it kind of explains that. So let me try to break this down a little bit easier than what they're saying. So basically, once you provide a service or product, even if you haven't been paid yet, you've transferred that service, you completed the service to that client, or you've transferred ownership of the product to the client. The time that service is completed or the product is transferred over to that other client, that is when the income is going to be reported. It's not when you actually receive it, and it's not when you decide to invoice them. It's when that transfer of ownership happens. So hopefully that makes more sense. This is why accrual method is funny and can be very difficult. So definitely recommend having a professional on accrual method help you through your accounting process and taxes. Income special rules. Following are special rules that apply to advance payments, estimating income, and changing a payment schedule for services. Estimated income. If you include a reasonably estimated amount in gross income and later determine the exact amount is different, take the difference into account in the tax year in which you make the determination. So if you provide a service and you estimated how much that service was worth and you reported that income in the 2022 tax year, but during 2023, you then invoiced and actually written down everything and submitted the invoice to them and working at getting paid, you then determine that the actual amount for the income should be higher or lower. That difference is then reported in that 2023 year when you've determined that difference. Advance payments. Generally, you must report an advance payment as income in the year you receive the payment. However, if you receive an advance payment, you can elect to postpone including the advance payment and income until the next tax year. You cannot postpone including any payment beyond that tax year. For more information, see publication 538. Expenses. Under an accrual method of accounting, you generally deduct or capitalize a business expense when both the following apply. The all events test has been met. The test has been met when all events have occurred that fix the fact of liability and the liability can be determined with reasonable accuracy. Number 2, economic performance has occurred. Economic performance. You generally cannot deduct or capitalize a business expense until economic performance occurs. If your expense is for property or services provided to you or for use of property, economic performance occurs as the property or services are provided or as the property is used. If your expense is for property or services you provided to others, economic performance occurs as you provide the property or services. An exception allows certain recurring items to be treated as incurred during a tax year, even though economic performance has not occurred. For more information on economic performance, see publication 538. This is just like a word salad. Let's see their example. Example, you are a calendar year taxpayer and use an accrual method of accounting. You buy office supplies in December 2022. You receive the supplies and the bill in December, but you pay the bill in January 2023. You can deduct the expenses in 2022 because all events that fix the fact of liability have occurred. The amount of the liability could be reasonably determined and economic performance occurred in that year. Your office supplies may qualify as a recurring expense. In that case, you can deduct them in 2022, even if the supplies are not delivered until 2022 when economic performance occurs. Okay, so that doesn't, I think it's a helpful example. So let me just try to break it down a little bit more to be a little bit more simpler. With accrual method, the expense is claimed in the year that it is incurred. And I said that before. So for example, you hire a contractor to do a service and they give you an estimate, but they're not, then they don't end up doing it until 2023. It is incurred in that 2022 tax year because you hired them, you signed the contract, you committed to them, and they gave you their quote. So you have a reasonable value to put to it. Same with their method, their example with office supplies. Say you buy office supplies on account. You make that purchase, you have the items, it's therefore expensed in that year, and you don't wait till you pay it in when you receive the bill in the next year. Again, funny stuff with accrual. Keeping inventory. When the production, purchase, or sale of merchandise is an income-producing factor in your business, you must generally take inventories into account at the beginning and the end of your tax year, unless you are a small business taxpayer. If you must account for an inventory, you must generally use an accrual method of accounting for your purchases and sales. When they say small business taxpayer, let me tell you, it accounts for a lot more people than you may realize. I will have to look up the exact number, so don't quote me on this, but I believe currently it's If you have inventory of less than $27 million, you're considered a small business and you don't have to use the accrual method of accounting. So we have different perspectives on what a small business is. Special rule for related persons. You cannot deduct business expenses and interest owed to a related person who uses the cash method of accounting until you make the payment and the corresponding amount is includable in the related person's gross income. Determine the relationship for this rule as of the end of the tax year for which the expense or interest would otherwise be deductible. If a deduction is not allowed under this rule, the rule will continue to apply even if your relationship with the person ends before the expense or interest is includable in the gross income of that person. Related persons include members of your immediate family, including siblings, either whole or half, your spouse, ancestors, or lineal descendants. So what this is saying is if you are doing business with your sister and she's cash method and you're accrual method, you cannot claim that expense or interest when that is incurred like you typically would with everything else with accrual method. You have to wait until she actually is able to claim that. So you have to match that. And that's only for related persons. Combination method. You can generally use any combination of cash, accrual, and special methods of accounting if the combination clearly shows your income and expenses and you use it consistently. That's their big thing with anything that you do, is that it has to be clear and relatable to your income and expenses, and it has to be consistent. However, the following restrictions apply. If an inventory is necessary to account for your income, you must generally use an accrual method for purchases and sales. You can use the cash method for all other items of income and expenses. If you use the cash method for figuring your income, you must use the cash method for reporting your expenses. If you use an accrual method for reporting your expenses, you must use an accrual method for figuring your income. If you use a combination method that includes the cash method, treat that combination method as the cash method. Inventories. Generally, if you produce, purchase, or sell merchandise in your business, you must keep an inventory and use an accrual method for purchases and sales of merchandise. Exception for small business taxpayers. If you are a small business taxpayer, you can choose not to keep an inventory, but you must still use a method of accounting for inventory that clearly reflects income. If you choose not to keep an inventory, you must be treated as failing to clearly reflect income if your method of accounting for inventory treats inventory as non-incidental material or supplies or conforms to your financial accounting treatment of inventories. If, however, you choose to keep an inventory, you must generally use an accrual method of accounting and value the inventory each year to determine your cost of goods sold in Part 3 of Schedule C. Small business taxpayer. You qualify as a small business taxpayer if you have an average annual gross receipts of $27 million or less for the 3 prior tax years. There you go. I was right. So insanely high amount for small businesses, and are not a tax shelter as defined by Section 448B3. If your business has not been in existence for all of the 3 tax year period used in figuring average gross receipts, base your average on the period it has existed. And if your business has a predecessor entity, include the gross receipts of the predecessor entity from 3 tax year period when figuring average gross receipts. If your business or predecessor entity had short tax years for any of the 3 tax year period, annualize your business's gross receipts for the short tax years that are a part of the 3-year period. See publication 538. Treating inventory as non-incidental material or supplies. If you account for inventories as materials and supplies that are not incidental, you deduct the amounts paid or incurred to acquire or produce the inventoriable items treated as non-incidental materials and supplies in the year in which they are first used or consumed in your operations. Inventory treated as non-incidental materials and supplies is used or consumed in your business in the year you provide the inventory to your customers. Financial accounting treatment of inventories. Your financial accounting treatment of inventories is determined with regard to the method of accounting you use in your applicable financial statement, as defined in section 451B3. Or if you do not have an applicable financial statement with regard to the method of accounting you use in your books and records that have been prepared in accordance with your accounting procedures. Changing your method of accounting for inventory. If you want to change your method of accounting for inventory, you must file Form 3115, the application for change in accounting method. Items included in inventory. If you are required to account for inventories, include the following items when accounting for your inventory: merchandise or stock in trade, raw materials, work in process, finished products, supplies that physically become a part of the item intended for sale. Valuing inventory. You must value your inventory at the beginning and end of each tax year to determine your cost of goods sold. To determine the value of your inventory, you need a method for identifying the items in your inventory and a method for valuing these items. Inventory valuation rules cannot be the same for all kinds of businesses. The method you use to value your inventory must conform to generally accepted accounting principles. For similar businesses, you must clearly reflect income. Your inventory practices must be consistent from year to year. And there's more information in publication 538. Just give a little bit of information for inventory and what they're saying. Basically, having a system in place to basically like an Excel sheet of every item that you have, and then the quantity of each item that you have, price that you're selling them for, and the price that you purchased them for, and their fair market value. So having all those lines in an Excel sheet at the beginning of year, going through that Excel sheet or whatever sheet that you have and confirming the quantity, adjusting the fair market value, adjusting the price that you're selling them for. And then so keep that. You should have a file for all your inventory statements. I suggest doing it every quarter so it doesn't become so cumbersome at the end of the year. But every other period that you do the next inventory audit, it's just again going through the quantity and adjusting the numbers, and keeping track of that. Valuation rules, again, like they said, will depend on your business. And because fair market value changes and prices change, you have to have a system in place to value your inventory. And an example of a system is LIFO, like last in, first out. So the oldest item is going to go out first, versus first in, first out. You purchase something new, and that's going to be the first thing that is sent out. So you use those values from those. It's a very complex accounting process. So again, having a professional to help guide you through who understands inventory valuation and the different methods for inventory and accrual method of accounting. Uniform capitalization rules. Under the uniform capitalization rules, you must capitalize the direct costs and part of indirect costs for production or resale activities. Include these costs in the basis of property you produce or acquire for resale, rather than claiming them as a current deduction. You recover the costs through depreciation, amortization, or cost of goods sold when you use, sell, otherwise dispose of the property. Activities subject to the uniform capitalization rules. You may be subject to the uniform capitalization rules if you do any of the following, unless the property is produced for your use other than in a business or an activity carried on for profit. Produce real or tangible personal property. For this purpose, tangible personal property includes a film, sound recording, videotape, book, or other similar property. Acquire property for resale. Exceptions. These rules do not apply for the following: Small business taxifiers defined earlier under inventory, so you have an average gross receipts over the past 3 years of $27 million or less. Property you produce if your indirect costs of producing the property are $200,000 or less. Special methods. There are special methods of accounting for certain items of income and expenses. These include the following: amortization, which is discussed in 535, bad debts, depreciation, installment sales, and long-term contract methods of accounting. Change in accounting method. Once you have set up your accounting method, you must generally get IRS approval before you change to another method. A change in your accounting method includes a change in your overall method, such as from cash to an accrual method, and your treatment of any material item. To get approval, you must file Form 3115. You can get IRS approval to change an accounting method under either the automatic change procedures or the advanced consent request procedures. You may have to pay a user fee. For more information, see the instructions for Form 3115. Automatic change procedures. Certain taxpayers can presume to have IRS approval to change their method of accounting. The approval is granted for the tax year for which the taxpayer requests a year of change, if the taxpayer complies with the provisions of the automatic change procedures. No user fee is required for an application filed under an automatic change procedure, generally covered in Revenue Procedure 2015-13, 2015-5, IRB 419, which is available at that link. Generally, you must file Form 3115 to request an automatic change. For more information, see the instructions for Form 3115. So, yes, that is Chapter 2. Lots of words. They like to add lots of words and they try to make it easy to understand, but then they also don't. So that was a lot of information. Sit on that until you go into Chapter 3, where we discuss disposition of property, business property. So getting rid of business property, how you report that and what that process looks like. Thank you for watching Chapter 2, and hopefully this is helpful for you, especially with my added tips in there. If you have any questions, feel free to leave them in the comments. Share this video with somebody that you think will need this information, and make sure you subscribe.